In the world of investing, there's a harsh truth nobody wants to hear. Buying is an apprentice's game, and selling is the mark of a master. Let's be completely real for a second. If you don't have a ruthless, ironclad exit strategy, every single dollar of unrealized profit sitting in your brokerage account isn't actually yours. It's just a temporary loan from the market, and trust me, the market always comes to collect. Today, we're going to break down one of the most brutal, undefeated laws of financial history, the law of mean reversion at extremes. We're going to talk about how to spot a market top and how to step off the ride gracefully to avoid the ultimate retail investor tragedy. You watch your portfolio go to the moon, only to ride it all the way back down to earth because you didn't know how to hit the sell button. At their core, financial markets are just a massive multiplayer game of human greed and fear, swinging back and forth like a pendulum. And when prices rip toward the extreme upside, they cast this crazy psychological spell on us, making us start believing that gravity is suddenly canceled. We start believing that trees really can grow to the sky, and all the boring traditional valuation models get tossed out the window. We start whispering the 5 most expensive words in investing history that this time is different, but spoiler alert, it never is. The laws of financial physics still apply, so think of the market like a rubber band. The further you stretch it away from reality, the more kinetic energy it builds up, and when it finally snaps back, it is extremely violent. Look, a lot of investors aren't stupid. They spot trends early, they ride the wave, and they make great paper money. But what completely destroys them is the addiction to that final euphoric 10%. Because the end of a market cycle always delivers the most face-melting explosive gains. It's designed to reward the reckless and punish the disciplined temporarily. So our goal here today is to learn how to take that temporary punishment with a smile. The payoff is keeping your wealth, so let's confront an uncomfortable question. Why is it that right when a cycle is about to die, smart, rational people lose their minds? They suddenly lose their minds and double down, and it's not a lack of IQ. It's basic human biology, because we are hardwired for herd behavior. A massive bull market is basically a casino that keeps giving everyone free drinks and raising the stakes, and in the beginning, you're skeptical and just dip a toe in. Maybe you turn 10 grand into 15 grand for a clean 50% return. You should be thrilled, but you aren't. Almost immediately, the joy mutates into regret, and you catch yourself staring at the ceiling at 2 a.m. You think, man, if I had just dumped my whole life savings in, I would be quitting my job tomorrow. That right there, that regret is the seed of your destruction. And as the chart keeps going up and to the right, something else happens. Suddenly, everyone around you is a financial genius, and your coworker who struggles to use a spreadsheet is making thousands a day. Your uncle is pitching you obscure altcoins at Thanksgiving, and the barista downstairs is giving you stock tips. When you see people around you seemingly leapfrogging into a higher tax bracket just by pressing buy on an app, your psychological firewall melts. You convince yourself it's not too late. You take your emergency fund, or maybe your house down payment, and you shove it all into the market. You do this at the exact moment valuations are blindingly radioactive. Why? Because the pain of missing out is physically worse than the fear of going broke. Think back to your worst trading loss. I guarantee it happened right after you told yourself, just one more leg up. Picture the scene. You were probably glued to a monitor, watching a massive green candle print doing the new car math in your head. You thought, if this just goes up another 20%, I can pay off my mortgage in cash. At that moment, you forgot why you even bought the asset in the first place. Fundamentals? Revenue? Who cares? The numbers were flashing green. That is the market's deadliest trap. It weaponizes your early profits to numb your judgment, leading you right to the edge of the cliff, begging you to jump. To break this curse, you have to understand how the pendulum actually swings, because markets spend almost zero time at fair value. They are either wildly undervalued or wildly overvalued. And when the pendulum is maxed out on the bubble side, it's held there by pure emotional inertia and leverage-fueled euphoria. But here's the golden rule you must tattoo on your brain. The speed of the drop will always be faster than the climb because bull markets take years to build. They need a constant, steady diet of new buyers. But bear markets, on the other hand, they only need one thing, a lack of liquidity. Once every single person who wants to buy has already bought, there's no new money left to push the price up, and the buying starves. And then, one tiny piece of bad news hits, and the whole thing unravels because greed takes years to build, but fear erupts in a millisecond. People take the stairs up, but they jump out the window on the way down, and we've seen this movie 100 times. Look at the dot-com bubble in 2000. If a company just slapped a dot-com at the end of its name, its stock went parabolic. No profits, no product, no problem. Wall Street literally started saying profits are a relic of the old economy. They said eyeballs and web traffic are the new metrics, because every bubble invents its own fairy tale to justify crazy prices. And how did that fairy tale end? The NASDAQ lost nearly 80% of its value, and trillions vanished. Even absolute juggernauts like Cisco took well over a decade just to break even again, so fast forward to the crypto craze. You know exactly what I'm talking about. Everyone on Twitter suddenly had laser eyes, and Super Bowl commercials were just crypto exchanges yelling at you to be brave. Dog-themed meme coins with zero utility were minting millionaires overnight, and when sentiment reaches that level of absolute fever-pitch delusion, traditional analysis is dead. Technicals are completely ignored, and the market becomes a dangerous place where gravity is temporarily suspended. Fundamentals are meaningless. It's just the greater fool theory on steroids. And when the music finally stopped, people who bought the top watched 90% of their net worth vaporize. So, what is the solution? And how do you actually walk away with the bag? You build your exit plan right now while your pulse is normal and you're fully rational. It needs to be brutally, coldly objective. So strip out your emotions, ignore your gut, and definitely ignore your desire to buy a boat. You need to build a system on two pillars of valuation extremes and momentum exhaustion, because every asset has a historical valuation range. When metrics like the PE ratio or MVRV in crypto push into the top 5% of their historical data, the market is screaming at you that things are priced for absolute perfection. When you enter that zone, your default reflex must be simple, and you must start selling, not all at once, but in tranches. Second is momentum exhaustion. If the price keeps hitting higher highs, but the trading volume is drying up, or your RSI is flashing a massive bearish divergence, the engine is running on fumes. It looks strong on the surface, but under the hood, the smart money and the whales are quietly dumping their bags onto the retail guys who were late to the party. This is where you execute a laddered exit strategy and a selling grid, but do not try to catch the exact top, because catching the top is a myth sold by fake internet gurus. Your goal is to exit early, exit gradually, and exit systematically. So here is a simple playbook for when your investment doubles. Set a strict rule to sell enough to cover your initial investment, because once you pull your principal out, your entire psychological state changes and you are playing with house money. You can finally breathe, and from there you set a mechanical trigger where for every extra 15% the price pushes up, you blindly sell 20% of your remaining stack. I'm going to level with you because this is going to feel awful, and when you sell and the price immediately goes up another 10%, your stomach will drop. You will feel like an idiot, but that discomfort and that sick feeling is the exact friction that keeps you safe. Just remember this one thing: the absolute best time to sell is when you are dead certain it is going to go up another 20%. When you're staring at your phone with hands literally shaking with adrenaline, thinking just one more month and my life changes forever, stop. You need to put the phone down, take a deep breath, and press sell, because you must not chase the last dollar where all the risk lives. Let some other gambler take that risk, because your job is to take your chips, stand up from the table, and walk out the door. While we are talking about risk, let's talk about the fastest way to ruin your life at the top of a cycle, and that is leverage. Using margin or leverage at market extremes is literal financial suicide. Because while leverage magnifies your gains, it completely destroys your margin for error. If you buy the top with cash, you might be underwater for a few years, but you will survive. But with leverage, a routine 20% pullback will liquidate your entire account. The irony is that markets get insanely choppy right before they die, and they do these violent shakeouts to test the waters. If you are leveraged, those little bumps will trigger a forced liquidation, wiping you off the board right before the market bounces back. Leverage turns the market into a high-speed Ferrari with no brakes heading toward a cliff. And one tiny pebble on the road means it is game over. Finally, let's talk about the ultimate boss fight, which is overcoming FOMO and actually keeping the money you just made. Let's say you followed the plan, you scaled out, you locked in your gains, and you stepped aside, and then the market rips another 50% without you. Your buddies are mocking you in the group chat, social media is throwing a party, and you start doubting yourself. You feel a deep dark urge to FOMO back in at the absolute peak, so you have to protect yourself from yourself. Step one is to create physical separation, because the second you sell, you must get the cash out of the brokerage account. As long as it sits there, your brain views it as ammo waiting to be fired. So move it to your boring everyday bank account to put friction before the buy button. Step two is to convert those speculative gains into boring, stable cash flowing assets. So don't let the cash sit idle, and definitely do not dump it into another high-risk play. Buy government bonds, lock it in fixed deposits, buy real estate, or just do something that pays you a quiet and steady yield. When you start seeing reliable cash flow hit your account every single month, your brain's reward system literally rewires itself. You stop craving the casino dopamine, and you start falling in love with stability, realizing that the peace of mind you have now is the direct reward for your discipline. At the end of the day, true investing isn't about flexing how much you made at the absolute peak of a bull market, because anybody can do that. It is really about surviving the bear market that inevitably follows, because true mastery is conquering your own greed when everyone else is losing their minds. It means bowing out with elegance and turning fleeting screen numbers into permanent tangible wealth, which is the final evolution of an investor. In a world completely full of temptation, your discipline is your ultimate superpower. So hold on to it, because it might just be the only thing that keeps you in the game.